Please welcome to the stage His Excellency Sheikh Bandar bin Mohammed bin Saoud Al-Thani, Governor of the Qatar Central Bank, and Nouriel Roubini, Chairman and CEO of Roubini Macro Associates, for a conversation with Bloomberg's Stephanie Flanders.
Thank you. We are seeing and experiencing something we haven't experienced, at least in many of the developed economies, for a long time: inflation, significant inflation. And we're using a phrase or a word that we haven't used also for a long time: stagflation. So, Nouriel Roubini, you're not always known for your optimism about the global economy, but listening to an interview you gave this morning, you seem not just long-term gloomy, but short-term gloomy. You think we're headed inevitably for a recession. So I guess my first question to you is a hard landing now inevitable? And if so, when did we go past the point of no return? When did you think, oh, this isn't going to end well?
Well, people like myself who were old enough remember the 1970s when you had two major oil shocks. The war in 73 between Israel and Arab states, and then in 79, the Islamic Revolution in Iran that led to oil embargoes, spike in oil prices, high inflation, and recession. And I think, unfortunately, this time around, we have both demand factors and supply factors that are causing stagflation and high inflation. On the demand side, of course, we had loose monetary and fiscal policies during COVID, with excess savings that now are leading to pent-up demand. But there were a series of negative supply shocks. First, the impact of COVID, lockdown, reduction of supply of labor, global supply chain problems. But this year we had also two other negative supply shocks: the brutal Russian invasion of Ukraine, rising energy prices, food, fertilizers, and industrial metals, and now the zero COVID policy of China is leading to slowdown of growth of China and further bottlenecks on the global supply. So we have a situation similar to the 70s: excessive aggregate demand and negative supply shocks. Now, central banks hope that they can raise rates just enough to slow down the economy, to bring back inflation to 2%. But the history of the last 40 years suggests that whenever, at least in the US, inflation is above 5%, and right now is 8.5%, and when unemployment is below 5%, right now it's 3.5%, any attempt by the Fed to essentially raise rates to fight inflation causes a hard landing rather than a soft landing. That's why my baseline scenario right now is of a hard landing for the US, for the Eurozone, for the UK, and most advanced economies.
Well, I was going to ask you quickly about that. So as far as you're concerned, the recession that we will see in the US will inevitably be followed by or come with a recession elsewhere?
Well, it's going to be followed by recession elsewhere for two series of reasons. First of all, when the US sneezes, the rest of the world gets a cold. The US is large enough that what happens economically and also in terms of financial markets in the US, that affects the global economy. Two, the same factors that are leading to recession in the US are occurring also in the Eurozone, Europe, and the United Kingdom. If anything, actually, I would say Europe is more exposed to Russia in terms of energy. Europe is more exposed to the slowdown of China, given trade with China. The euro is falling in value, and that's inflationary. And the recovery of Europe was more anemic than the United States. So in some sense, Europe, Eurozone, and UK are as fragile, if not more fragile, than the United States.
Well, we'll come back to some of this, but Your Excellency, I guess I should ask you, does the vision of the global economy that Nouriel Roubini has just laid out, is that consistent with what you're seeing, and what's the impact particularly in Qatar?
Thanks for having me. In fact, the global economy is facing a perfect storm of rising food and energy prices, along with an increase in interest rate. The impact of this storm might vary from country to other. Those countries with high income, self-sufficient production of commodities in my view, will be more prepared to withstand this storm. On the other hand, those countries with low income and import most of their food and energy might face a very difficult time and a high inflationary pressure. Central banks started to reduce the demand. However, if the supply side remain uncertain, then the central bank's action might be limited. In my view, this year we might face a stagflation, and we might be in recession by 2023.
And you have a peg with the dollar, which means you have to follow the Federal Reserve quite closely. You raised interest rates by 0.75 of a percentage point recently. Do you expect in the future, just as a matter of expectation, that you will follow exactly what the Fed does, or do you have some room to move around?
Yeah. Stephanie, we have a very effective monetary and exchange rate policy. We have increased the interest rate twice this year, in total of 125%. We have an inflation of 5.18% in Qatar. The effectiveness of our monetary and exchange rate policy is benefiting us. We have experienced and witnessed an inflow of capital recently. This approved our monetary and exchange rate policy. We act to contain the inflation in the state of Qatar, and we believe that we are aligned with U.S. As well. So we expect that to increase the interest rate to contain the inflation.
And you don't sometimes wonder, I mean, the Fed has now had a lot of criticism. By any stretch, it kind of failed in its one job, which was controlling inflation. Do you sometimes regret that you've contracted out so much of your monetary policy to the Fed? Now it's screwed up?
Actually, yeah, we heard some criticism on the Fed, but if we go back to the time, at that time, when the Fed took the decision not to increase the interest rate, the world situation were different. There was no war in Ukraine, and most of the economies just reopened again. So the situation is different now. We have different situation. We have war in Ukraine. We have the supply chain disruption, and China's zero COVID policy in a place, still in a place. So it's very difficult for policymakers to take decision. They take decision based on data that they have. So, but circumstances could change in the future that you don't expect to happen. This is my view to it.
I mean, Nouriel, how different is the US problem to the rest of the world? I mean, we don't want to go back sort of beating up on the Fed for the sake of it. I think it's more about what should central banks do now. And we have some understanding about what the Fed's going to do. But would you say that Europe potentially has more or less room in terms of the central bank response? I mean, they don't face the same kind of demand issue that the US faces. Or is really fundamentally the problems quite similar now in Europe?
Well, in terms of levels of inflation rates, the levels in the Eurozone right now are as high as the United States. In the UK, it's even worse than that. Among advanced economies, the only one that has much lower inflation is still Japan. That explains why the BOJ policy is very different. And it's true that the nature of inflation in Europe might be slightly different, more exposure to energy and Russia, more of headline inflation rather than core. Because of that, slightly less strong wage dynamics, more supply shocks rather than aggregate demand shocks. But in a world where you have this stagflationary shock, whether you're the Fed, the ECB, the BOA, SMB, RBA, or you name it, you are in trouble because whenever you have these stagflationary shocks, inflation is higher, growth is lower. If you care about inflation and not the anchoring inflation expectation, you have to exit and normalize sooner and faster, but that increases the risk of a hard landing. And if instead you care also about economic growth and you normalize more slowly, then the risk is that you're going to have a de-anchoring of inflation expectation. And whether the shock is supply or demand, in some sense, doesn't matter. Even in the presence of a supply shock, like we learned from the 70s, if you don't fight inflation, inflation expectation get de-anchored, and you end up with stagflation, not just with inflation, but also recession. And I would say the ECB is as much in a pickle as the Fed, given the exposure to Russia, given the exposure to China, given the more anemic recovery, given that the euro is falling in value, and therefore you're going to have more imported inflation. So the problems are similar.
And when you think about the sort of global knock-on effects of this, or we would call the spillovers, I mean, we had years after the global financial crisis where we talked about currency wars, and the game in currency wars was to depreciate your currency and try and import some inflation because inflation was too low. What's the risk now, or how much are we already seeing, the reverse of that, a stronger the US in effect trying to export inflation through a stronger dollar?
Yeah, a stronger dollar implies that inflation is higher in Europe, inflation is higher in other advanced economies, but more importantly, inflation is also much higher in emerging markets. We've spoken about advanced economies, but in some sense, the situation of emerging markets is more difficult. Of course, you have to make a caveat. There are some emerging markets that are energy and or commodity exporters. Those are doing well, like in the region. There are some emerging markets that have stronger macroeconomic fundamentals with lower inflation. But you know, the typical EM that is net commodity importer now is facing raising rates in the United States with weakening of their currencies that leads to higher inflation and with higher borrowing costs. It has a terms of trade shock because especially in Asia, but also in many other emerging markets, they are net commodity importers. And for them, the rise in energy, food, fertilizer, industrial metal is a major economic shock. Of course, if you are in very poor countries, you get to the point in which they have to worry about hunger, if not famines, like in sub-Saharan Africa. And the third shock for emerging market is this slowdown of China that is now significantly also affecting negatively, especially economic growth in Asia, that is connected to the global supply chains of China. So you got the Fed shock, you get the dollar shock, you get the terms of trade shock, you get the China shock. So that's why folks at the World Bank and IMF say for many emerging markets or poor countries, this is not a COVID recession, it's a near depression that they have to worry about.
And Your Excellency, I mean, if we see big currency moves coming out of this, and particularly the dollar strengthening or big swings in the dollar, could you anticipate, I know you would never talk about changes in exchange rate regimes in the short term, but can you anticipate me wanting to move to maybe a more flexible peg or a slightly more flexible system?
As I mentioned before, our monetary and exchange rate policy is working very effectively for our economy. Also, the IMF recently in their reports highlighted that the pegged exchange rate to US dollar for GCC is remain proper. So we don't see any changes to our exchange rate policy. And as I mentioned, we are witnessing an inflow of capital to Qatar stock exchange market. This is an approval of the effectiveness of our policy. So we don't see any changes in.
And are you confident? You mentioned the inflation rate. It's one of the highest inflation rates in the Gulf. Are you confident that you have the tools to bring down inflation when you have other factors potentially pushing it up, like the World Cup, for example?
Yeah, it's a great question, Stephanie. We have a different economic situation in Qatar. We've been investing in our infrastructure since the last 10 years for the preparation for the World Cup. And as well as that, we have an economic activities different than the rest of the GCC countries. We are going to host a major event this year, and this event will boost the activities, economic activities in state of Qatar. So it is normal that we have a little bit higher interest rate, but our aim here to contain the inflation in the state of Qatar, and we have the tools to do so.
I had another question for you, and it came up in the earlier discussion today. There was much debate after the seizing of the Russian foreign exchange reserves unexpectedly in response to the Russian invasion, that central banks around the world would be thinking about how their reserves were allocated and perhaps not wanting to have so much dollar exposure. Is that a conversation that you've had in the central bank?
Actually, we have a diversified portfolio in the central bank. We have different major currencies in our portfolio. So we are well diversified, and this is our strategy always, to diversify and not to depend on one currency in our portfolio. So we will continue to do so.
You didn't see any potential to need to change in the unexpected sanctions on the reserves, the Russian reserves?
Actually, our diversification is in Europe and in US and Far East, so it's very well diversified portfolio before all of these incidents happening. So we are not worried, and we are very confident of our portfolio.
Now, Nouriel, we're going to run out of time, but you have spoken quite a lot about crypto in the past, and I was interested, given it's been a pretty turbulent ride for a lot of the cryptocurrencies in the last few months, how are you looking at is it the future? Was it a fad, or is it the future, or are you changing your view?
Well, from the peak of last November, Bitcoin has lost about 70% of its value. Other cryptocurrencies have lost 80 to 90% of them. You know, the study suggests that 90% of all ICOs were scams of one sort or another. I think, however, the most important point is that calling cryptocurrencies currencies is a misnomer. Anybody who knows about monetary theory and policy, like His Excellency, knows that for something to be money or currency, it has to be unit of account. Nothing is a price in Bitcoin. It has to be a scalable means of payment. With Bitcoin, you can do 7 transactions per second. With the Visa network, you can make 50,000. It has to be a stable store of value. Here you have an asset that can go up and down in value overnight by 10, 20%. Not even crypto conferences accept Bitcoin as a means of payment or a store of value. And it has to be a single numeraire, so you can price the relative price of goods and services. If every good and service is a different token, it's like going back to barter. You cannot even see the relative price. So calling them currencies is really a misnomer.
But is it the death of that misunderstanding? If it was a misunderstanding, what's happened in the last few months? Will people come to their senses, do you think?
Well, there was a huge bubble. There was a fear of missing out. There were Ponzi schemes. Many people have bought at their peak, and now they've lost a fortune, whether in cryptocurrency, crypto assets, DeFi, and so on. I think that in this space, if you want stuff that is going to be not vaporware, you need to find asset-backed tokens of one sort or another that are backed by real assets or financial assets. Otherwise, those that are based on essentially vaporware are going to be disappearing over time.
Excellency, are you as damning of crypto? Is the official line that cryptocurrencies are not currencies?
Crypto assets are technology innovation, and in my view, it might take us to a new era of fast, cheap, and more accessible to payments and financial services. However, those crypto assets, which is not underlying by an asset or monetary authority, might be less credible. Many central banks now are discovering to issue their CBDC, and we are not an exception of that. But we are still in foundation stage. We are evaluating the pros and cons of issuing the CBDC and to find the proper and the right technology and the platform to issue our CBDC.
I hesitate to ask this final question to you, Nouriel, but I was looking at my notes, and the last time we spoke, which was more or less in the middle of COVID, you were predicting that there would be some inflation coming out of COVID that would cause policy mistakes, and you would then have a 10-year depression in most of the world economy, give or take. Are we more or less on course for that, or can we expect something slightly better?
I certainly worry about stagflation in the short run, but I think that the factors that might lead into mediocre growth are not just short term. If you look at medium term, there are a whole series of other negative supply shocks. We have deglobalization and protectionism. We have reshoring of manufacturing from low cost to high cost. You have aging of populations. You have restriction to migration. You have this decoupling between US and China. You have global climate change. In many channels is stagflation, reducing growth and increasing cost of production. You have, unfortunately, recurrent pandemics. You have cyber warfare. You have a backlash against income and wealth inequality. You have the weaponization of the US dollar. These are all factors that are not short-term, that over time may reduce growth, increase cost of production, and being stagflationary. So unless we address this issue, we could end up not with a mild recession, but something more like a depression with inflation, meaning a deep stagflationary debt crisis, yes.
Ladies and gentlemen, Dr. Doom and His Excellency, thank you very much.
You're welcome.